Despite signs of easing inflation, long-term interest rates have edged higher, not just in the U.S., but globally as well, following the Bank of Japan's recent move to loosen its yield curve control. And our next guest says that this will have major ramifications for this country, the United States. Bleakley Financial Group's Chief Investment Officer. And also the Boockvar book report editor, Peter Boockvar, joins us now. Peter is also a CNBC contributor. Such a small move, and after so many years, it is significant, I guess. But why will it have so many ramifications for us? I'm talking about widening the band, raising the band.
Well, I think over the last couple of years, when we look at where all the excesses from global monetary policy, it was reflected in sovereign bonds. And with negative interest rates being sort of the epitome of massive financial bubble where central banks turned an asset into a liability. So now that we have the reversal of that, the BOJ is the last major central bank holdout to tighten policy. And when yields rise in Europe, they rise in the U.S. When yields rise in Japan, they rise in Europe and the U.S. We're all sort of highly correlated in terms of the movements in interest rates. Now, with respect to the BOJ in particular, widening the band also makes JGBs more attractive. Japan's the largest holder of U.S. Treasuries from a foreign perspective. So there's potentially flows that leave the U.S. and go to Japan. And I think it's just this sovereign bond unwind. Markets got comfortable that inflation was moderating, the Fed's almost done raising interest rates, thinking that it was all clear. And I think this rise in longer-term yields took us all by surprise because of the Bank of Japan moving quicker than we thought. But maybe for the first time ever, U.S. debts and deficits actually matter. And I say that for the first time ever because it was the 1980s when people were first talking about, oh, my God, the U.S. Budget deficit is getting out of control. And here we are 40-plus years later, and it hasn't mattered. But maybe this time it does matter.
Jed Gregg was on talking about debt to GDP. It's never been this high. And he thinks by 2030 it could be 130, 135%. Is there any way to stop that?
The only way is to grow out of it because those debt levels are still going to rise by that pace, particularly because of all the entitlement programs. And you just need to grow faster than that. And, that's going to be the big question. Right now, of course, we're not. Debt is growing much faster than the rate of GDP growth. And because we are a debt or a credit-dependent economy, the changes in the cost of capital has a notable impact on U.S. economic growth because we've relied less on savings and more on credit to grow. And this is an adjustment that's going to take years for us to get accustomed to, this higher rate environment.
It's probably not a great lesson that we'll learn. If we completely avoid a recession after the binge in fiscal and monetary spending that we had over the past 5 years, if we get a soft landing, then does that make us think we can do this again and again and again? Do you think we're going to have a recession anymore, Peter?
I do, but we may even have a soft one. But the question is not just if we have a modest recession. It's how quickly can we rebound? For how long do we see little growth? Because if we grow 1%, there's no growth, or we decline by 1%, it's all going to feel the same. And I think as this higher cost of capital sort of ensnares more and more businesses, more and more households, I think we have a period of time of pretty anemic economic growth. So again, a soft landing, hard landing. A hard landing sometimes is good in the sense that you bounce back rather quickly. A soft landing where you don't bounce back much may not be really any better. So like I've said before, I'm more worried about like a death by 1,000 cuts situation here, again, as we have to deal with this higher cost of capital and more cash is allocated to interest expense rather than growth and hiring.
Okay. All right, Peter, from what I take away from you is we need growth, but we're not going to get it. So we will hit 130% then, or 135%.
We won't get it for the next couple of years, but having positive real interest rates
it's not going to get any better. We're not going to spend less
over time.
We're not going to grow. Why? How are we going to grow? What are we going to grow from? All these plans that we're implementing. Do you ever grow from government spending? Does that ever work where you actually get GDP growth long term from just spending?
It's
not
only
private
a short-term fill. We need the private sector.
I know.
That's our only savior here, Joe.